Hello and welcome to the Elementary Credit Repair Credit Scoring video series. Today we're going to talk about the most important three-digit number in your life, your credit score. Credit scores are derived from credit reports. Your credit score is used for more than just borrowing money. It will be used for landlords deciding to rent to you and for hiring purpose when applying for jobs. It will also be used to determine insurance rates and whether you must pay a deposit when opening a utility account or cell phone account. Yes, that's correct. They use that today to determine those things. Your credit report may determine the job you can get. For example,
47% of employers do conduct credit checks on new potential hires, and it is legal if the employer gets permission from the applicant.
There are three major credit bureaus: TransUnion, Equifax, and Experian. Today, we want to talk about one portion of your credit report in the 4-video series: payment history. In most cases, your payment history makes up about 30% of your credit score. It's very important that you understand payment history and how to keep it in good standing. In the video series, we're going to break it down into 4 easy to understand short videos. But in this series, we're going to cover how credit scoring works. In this series, we're going to cover how credit scoring works based on FICO algorithm and its predictive analytics, which basically means that they collect information and analyze it to predict what's most likely going to happen. Now, this pertains to the scoring model and how credit score is factored. The scoring model is looking to predict the probability of your risk level. It uses algorithms to predict this. So it's going to try to predict you being 90 days late within the next 2 years. Yes, algorithms were designed to predict when you would fail to make payments. And I know that's pretty interesting to you. So in payment history, the scoring model is looking for the age of delinquency. Did it happen in the last month or in the last 5 years? And remember, the scoring model's greatest concern is with what happened within the last 2 years. So the type of delinquency or the severity of the delinquency is going to determine if you were 30 days, 60, 90, or more days late on any one particular item. So once you hit that 90-day late mark, you've just done exactly what the scoring model or scoring algorithms were looking for. So be careful with this. Now, it'll show a serious derogatory mark on your credit, and that's what we're trying to avoid. So if you run into trouble with your finances, you can still come out on top. I mean, it happens to people. This is a thing of life, but you really have to know what to do to keep clear of this. So you may just jump into survival mode, but review your bills, and we're talking about mortgages, car loans, installment loans, or credit card payments. Find out the due dates. You may have some that's due later than others, and once you identify this, those are the items that you're going to be mostly concerned with. Your utility bills can wait. Just call your local provider, let them know that you're going to pay late, and they should accept that. Lenders or creditors won't. It'll put a late mark on your credit. So your local credit provider, utility provider, will probably ask you for the day that you're going to pay. So make sure you know that day, what that day is when you're going to call them. But here, the point is, utility bills are not going to report on your credit report. However, if you default on them and they go into collections, they will. But that's a whole nother conversation. So we have more flexibility with moving these payments around. Now you can pay items that are currently due that are reported in your credit report. And once again, those are mortgages, auto or installment loans, or credit cards. Sometimes you just have to rob Peter and pay Paul. These are the things that we deal with in life. But this is so you can stay on top, and avoid the crosshairs of those scoring factor algorithms. Don't let them predict what they think you're going to do. And now doing this, if it occurs, will greatly help you manage your credit score and keep it where it needs to be. So with all that being said, bankruptcy, garnishments, and collection judgments, these are all major derogatory marks, right? But they're also in the same category as a 90-day late. The difference between a bankruptcy and a 90-day late is when you file for bankruptcy, you file for everything that's on your entire credit report or all the items that you're adding into your bankruptcy. This puts you in a totally different category. Whereas if you have a 90-day late, it's only one item on your credit report. Now, past due notices simply destroy a credit report. So once you're auditing your own credit report, what you want to make sure of is that there's nothing that's showing past due. Some of you may be surprised what you find when you look at your credit report, because a lot of derogatory things don't come to light or come to your attention until you're looking to buy a home and you're looking at your credit report. Now, usually when you see a collection item on your credit report, it'll show as past due. Also, mortgage payments can show past due. Now, if the payment was past due on the 1st and it's the 16th and you have not made that payment, they don't report as 30 days late. But we've seen them report past due. You also want to pay attention to this. If you're trying to get a mortgage and you decide that you want to pay all your unpaid collections off, and you find that some are older than 2 years and have not been recently updated, this could potentially lower your score. Yeah, so you have to be careful of this. Paying older items that are older than 2 years can lower your score dramatically. So, and that will not help you. So the reason for this is because collection agencies don't always update their reports regularly, so it may not show on your credit report. When you pay an older collection off, it'll update the report to show that that it's been paid, and then the model will look at it as a newer item, and that can lower your score substantially. Another item to keep in mind, if you're in the process of buying a home, I recommend, if the lender wants collections paid before the loan closes, that you pay those items at closing. Now, that's just as long as you qualify for the loan, whereas your current scores, if not, then I recommend you making sure you have 3 to 6 months to recuperate from the decrease in that credit score, which will happen as a result of paying off older collection accounts that were not updated on your credit score. Finally, when it comes to negative items falling off the credit report automatically, this is a myth, and I'm going to say it again. When it comes to negative items falling off your credit report automatically, this is a myth. It doesn't always happen. In theory, it's supposed to, but there are times, for whatever reasons, they do not fall off. So they must be disputed with the bureaus that they're reporting on. And these are obsolete or zombie debt. They need to be removed, basically. I know that was a lot of information. Watch the video again if you missed anything. If you have any questions, email us at info@elementarycreditrepair.com. Thank you for watching video 1 of the credit scoring video series. Thank you.